All right, well, welcome back to this part two of talking about financing with Mr. Jim Binion with NEXA Mortgage. I'm Rick Hendricks again, just to remind you, with Keller Williams Realty and the Hendricks team. So let's get right back at it. Jim, let's continue our conversation by talking about the difference between pre-qualification and pre-approval and how that can affect the benefits and potential home buyers.
Right, right. Pre-qualification, like I said in the earlier video, when I first talked to you, the buyer,
Yeah.
and I'm asking you questions, I'm pre-qualifying you in my mind. A pre-qualification is worth about as much as the piece of paper it's printed on. Okay, because there's,
Okay.
you know what I mean? A pre-approval is I've got your income docs, I've verified it, and I've actually ran it through the automatic underwriting system and I've gotten a pre-approval. That you can take to look at houses and you can feel pretty confident unless something crazy comes up that you're going to get that loan. And I'll tell you a quick story. Um, I had a client, well, I didn't have a client, a realtor had a client who was pre-approved or pre-qualified through a large national lender. Um, and so they put their house up for sale and they got it under contract. Well, then when they went to get the loan, they picked out a house and went to get a loan with this big national lender. They couldn't get a loan. And so then they came to me for a loan. I couldn't get them. I mean, it was really bad. And their
Wow.
house sold and they ended up having to live in a hotel. Um, so yeah, don't go off a pre-qualification. Always make sure it's pre-approved. Make sure they've ran it through automatic underwriting system. Make sure you've sent them your income docs because you don't want no surprises.
That's true, and that's really good
Yeah.
information. Along that lines, can you talk about things to do or not to do when you're in the financing process, like accounts?
Yes.
Should you open or close accounts?
Yes. So the answer to that is do nothing. Don't open an account. Don't close an account. Don't go buy a new truck. Don't don't do anything
Why
until
is
that
that? Why is that?
because when you do, it'll affect your credit score.
Okay.
And so when your credit score, I'll give you an example. I have a guy right now who's a seasoned investor and doing a loan for him, and we were doing 15% down. Well, he went and opened another line of credit and it dropped his credit score. Now he's got to put 20% down. So,
Oh,
and he should have known. He's done it a million times, you know. Um, so yeah, don't do anything. Don't go out and buy no furniture for your new house. Don't just don't do nothing.
well, what about if you have an issue, like say, unforeseen, your car engine blows up and you have to do something? You have to either get a new engine, get a new car. What do you do then?
Walk.
Okay.
Get a loan from mom and dad. No, I mean just I don't know the answer to that besides don't put it on a credit card.
All right.
Don't go out and get a loan for it. Just get on a bicycle or something. That's all I can tell you.
All right. Well, why not close credit cards? Do you think that would help your credit score once you get that closed? Why not close it?
You would think so, but credit reporting agencies are weird. Like when you close an account, the credit report agency looks at that as a negative because you just lost a line of credit.
Okay.
So that's why. Now you can pay off a credit card, but don't close it.
Okay.
You know, keep that line of credit open. Don't pay your car off during this process either, because it will
Really?
drop your credit. Yeah.
Wow.
Um, you pay it down to where you got one payment left, you know. But oh, and well, here's something to know too. When we're figuring out, so there's three things involved in you getting a loan. It's your credit score, it's your debt to income ratio. In other words, how much money do you have coming in and how much money do you have going out with the new mortgage? Okay.
Okay. Hmm.
And then there's how much you're putting down. Those are the three biggest things right there. Um, but a cool little thing is on your credit report, if you owe less than 10 payments on something, then we don't have to put that in your debt to income ratio.
Really?
So if you're real close, right, then like I had a guy a couple months ago, his debt to income ratio was just a little bit high. So he paid $3,000 on his car payment to get it below 10 payments, and then we could take that car payment out of the debt to income ratio.
Wow.
Yeah, so we ended up getting a loan done
Wow. I
now.
was not aware of that.
Sometimes you have to be creative when it comes to financing. It's not, there's an, we talk about it, there is no black and white when it comes to financing. It is all gray.
Yeah.
And that's why you hire somebody like me is to go through the gray for you because it's even me as long as I've done this, I still learn new stuff every single day. And the rules
Oh,
change all
yeah.
the time. All the
Yeah.
time the rules change.
Yeah. Same
So
with real estate. We're always learning new things too.
right. When I was in the mortgage business 20 years ago, and then I came back to the mortgage business 2 years ago, I had to relearn everything.
Wow.
And I mean, the basics are the basics, but as far as the laws and the guidelines and the restrictions and all that stuff had changed. And
Yeah.
so um, it's a never ending learning process, you know?
Yeah. Well, that's definitely for sure. I mean, you're always running into something new with every
Oh,
transaction that you do.
constantly.
Yeah.
Yeah,
Yeah.
yeah.
So let me ask you too, with the credit card, let's say you have a $5,000 limit.
Hmm.
How much of that can you keep on your credit card without it affecting your credit? Should you bring it down to almost nothing, or is there an amount?
Ideally, you want to keep it below 30%.
Okay.
Um, when you go above 30%, it will start affecting your credit negatively just a little bit until you hit that 50% mark. Once you start going on 50%, then it's a bigger impact.
Yeah.
So I always tell people 30% um, or less
Yeah.
or
Okay. Well,
less.
that's a good number to have. Let me ask you, let me see. Another question I have is, are there any special considerations or requirements for investment property loans or jumbo loans? What's the value to any of the clients?
Wow. The value for a jumbo loan is you get a bigger, nicer house. It's a little higher interest rate because it's a jumbo loan.
Can you
But
explain a little
jumbo,
bit what a jumbo loan is?
so you have um, maximum amounts. So let's say Fannie Mae says, okay, in this area, and they recalculate this every year, but let's say in this area, the max loan amount is $760,432 for this year. So when you go over that, now you come out beyond Fannie Mae guidelines, and now you've become a jumbo loan. Does that make sense?
Yeah.
So the government, or not the government, but Fannie Mae, Freddie Mac, they kind of set those guidelines every year, and so there's a maximum loan amount you can go that way. So anything over that, then we go into the jumbo.
All right.
Now, when we talk about investment loans,
Mhm.
there's huge advantages to those.
Right.
So you can do a regular investment loan, conforming loan, um, do a second home, however, and it's just like anything and any other loan, and it adds to your rate a little bit because it is an investment property. But they have a program now. It's called a DSCR loan, and this loan is amazing and it's very, very popular. So let's say you're an investor or you want to be an investor. Um, let's say you're self-employed already and you write everything off on your taxes, right?
Yeah.
Because you know how it is. Well, with a DSCR loan, as long as you have a credit score of at least 620, you can buy an investment property and they'll base the income on the income the property produces, not
Hmm.
what you produce. So there now some of them are no ratios, some of them have ratios. So let's say you're going to buy an investment property and the mortgage with the taxes and insurance, everything is going to come to $1,000. When that appraiser comes out, he does an extra form. It's called a 1007, and he will do the average area rental income, and he'll give you a number on that 1007. As long as that number is higher than, sorry, as long as that number is higher than what your payment's going to be, then you can get that DSCR loan.
Okay.
And as long as it falls into ratios. And the nice thing about it is you can get up to 20 properties that way.
Wow.
So if you really want to build residual income through rental, that's a great way to go. And they'll also do short-term DSCR. So let's say you don't want to do long-term rentals, you just want to Airbnb everything. That's fine. We do it that way too. And now it's done a little differently when it comes to the 1007 because the 1007 is more for a long-term rental.
Yeah.
But the lenders have software where they'll pull up Airbnb and see what the average Airbnb is in that area, and they can still come up with a value for you.
Wow. That's
And the nice thing about that is there's no tax returns required. There's no pay stubs required. They do want you to have reserves.
hmm
Um, at least depending on the lender and depending on your credit score, at least 3 months, but it can go all the way to 12 months reserves. And what that means is they want to see, let's say your monthly payment's $1,000 a month and you need 3 months reserves. So they need to see $3,000 sitting somewhere, whether it's in a 401k or it's in a savings account, checking account, stocks, bonds, somewhere. If you
Okay.
got to do 12 months, then they're going to want to see $1,200 sitting somewhere. And you don't have to touch that money and you don't have to take that money out. It's just got to be sitting there. And the reason they do that is it's kind of a backup. If you they want to know if you got in a tight situation, would you be able to pay the mortgage for the next 3 months or the next 6 months or whatever?
Makes sense. Yeah.
Yeah, yeah.
Yeah. All right. Oh, that's great. Thank you for all that.
Oh, let me add something to that
Yeah, go right
DSCR.
ahead.
So I am licensed in Ohio, North Carolina, and Tennessee, right? But DSCR loans, these are business type loans. So I can actually do those loans in most states. There's only about 5 states that require a license for that. And it's the same thing with commercial as well. You can be a loan officer and licensed in a certain state, but when it comes to commercial or when it comes to business type loans, you can do multiple states with those.
That's awesome. So how does
Yeah,
that differ from any other loan officer? You had mentioned too, I believe that you are a broker.
right.
How is that different from anybody else?
Well, that part is not necessarily different. What's
Okay.
different is like I've worked for a direct lender where, um, just like any retail lender that you know of out there. I'm not going to throw out names or anything like
Right.
that. And with the lender, you're limited to the loan programs that lender has, right?
Okay.
But there's thousands of loan programs out there. As a broker, I have all the loan programs out there. So I have 245 lenders, and those 245 lenders all have different programs, right? So in so the advantage of using a broker is one, I get pricing at wholesale pricing. So just like anything, if you buy at wholesale, it's always cheaper than if you buy at retail, right? So when it comes to interest rates, we get wholesale interest rates a little
Cool.
better.
Yeah.
The other thing is if you went to 10 lenders looking for a loan and they pulled your credit 10 times, then guess what? Your credit's in the hole now because it's been pulled 10 times. and you're frustrated and you're irritated and you got to tell the same people or different people the same thing over and over and over again. See, that's my job. I have your credit report and it's only pulled one time, and then I send that to the lenders and say, hey, what can you do on this loan? What can you do? And I get the different pricing. So this lender might say, well, we can do this at 6.9%. This lender might say we can do it at 6.75%. So I go out and I shop it for you. So you don't have to do that. And I shop the best rate. So I try to find you the best rate. Sometimes it's not about the rate though. Like I have lenders that I can send a loan to and it's out of underwriting in like 2 days. But
Wow.
then I have a lender that maybe is a little better interest rate, but it'll take 2 weeks to come out of underwriting. So it's kind of like pick your poison a little bit there,
Yeah.
you
Yeah.
know. And the difference in the rate's not enough to want extra headaches. You know what I mean?
Yeah.
Especially with North Carolina and due diligence and everything. You don't want to lose your due diligence money because something didn't get clear at closing time.
Exactly. Exactly.
Um, we can usually close most loans in 20 days or less.
That's fantastic. And that's with
Depending
appraisal
on the
and
loan.
everything.
Yeah, yeah.
Yeah.
Now, with that said, you know, there's always hiccups and things come up that you didn't expect and
Sure.
stuff. But on an average, 20 days or less.
Wow.
The other thing I want to add about being a broker
Yeah.
is so I build relationships with these lenders. So I'll give you an example. One of the lenders I use it's the largest mortgage company in the country, actually. Um, they make us jump through all these hoops. We got to watch videos and we got to do this and we got to do that. We earn all these points every month and stuff, but we go up higher scales as we do these points. Well, the
Yeah.
advantage of that is like when I go in and price a loan with that lender, I get to take an extra 40 basis points off of that for my borrower
Okay.
because I'm out there watching videos and doing all this stuff and doing the stuff they're asking me to do. Um, so that could be the difference between someone qualifying because of debt to income. Let's say they're right on the cusp and rates this, and then I can get 40 basis points off of that. And now, boom, they qualify, you know,
Wow.
so it can really make a difference. And
Wow.
the pricing, another thing too, is with my fees, like what I charge, you know exactly up front, it's disclosed to you. Here's my origination fee. A lot of times with other lenders and direct lenders and stuff, they'll tell people, um, oh, we'll do this for no origination fee. And you know that's not true. It's nobody's going to work for free, right?
Right. Right.
So what they do is they bury that in the rate or
Mhm.
in somewhere in those loan papers somewhere. You're still paying the same amount, if not more. You just don't see it. And so with the broker, I like being a broker because I could just say, here's what it is, and that's the one black and white thing that is here is the fact that you're going to know the numbers, you know.
Yeah. Wow. That's fantastic. So yeah, there is a difference then.
Big
And one of the
difference.
big difference is
Well,
the credit
I'll
score.
add one more thing to that. Well,
Yeah.
that too. When I was a lender, I
Hmm.
approved about 50% of my applications. As a
Uh-huh.
broker, I approved about 96%.
Wow.
Big difference. Yeah.
That's a big difference. Yes. Big
Mhm.
time. Well, let me ask you one more question. This is dealing with the current market rates. Are there any current market trends or updates in mortgage lending that clients should be aware of?
Um, It's hard to say. I mean, they're talking about the Feds in June. The Feds have their meeting again in June, and they're expecting
Right?
interest rates. Some people say they're expecting them to come up. Some people say they expect them to go down. It depends on inflation. It depends on the job market. There's so many things that depends. This last rate hike that we had, I actually thought it was going to go down, and I got surprised. I was like, "Oh wow, it went up." Luckily, I had all my loans were locked, so my clients were not affected by that. Um, so I don't know if the rates are going to go up. I think I would think closer you get to an election that the rates will go down,
Yeah.
but you just really don't know right now. Um, I will say this, and I said this in part one, your 2% and 3% interest rates, I don't see those coming back anytime soon. I think we're going to settle around 5 and 5.5%, but again, I don't know that for sure. And people got to understand where we're at right now is actually average. If you
Yeah.
look back in history, I remember when I was a kid. I'm gonna tell my age. Jimmy Carter was president. Interest rates are like 14%.
Yeah.
You know, when I was in the mortgage business back in early 2000s, you were getting a great interest rate if you were at 6% or 5.85%. So um, waiting on a rate is not going to do you any good if you think that those days are going to come back, because it's not going to be anytime soon.
Yeah.
And
Yeah.
again, back to when rates were 14%, people were paying $40,000 for a new home. you know,
That's
and
true.
the home prices just keep going up and up and up. And I will say too, um, you know, what I the other thing about lending is, and this is why your debt to income ratio is so important, is because we don't want to put you in a loan you can't afford. Um, because that's how you get in trouble. That's how people get into foreclosures.
Right.
You know, foreclosures are up 117% right now.
Wow.
So it's that's something that I would talk to about the buyer when they come, and I like to say, and they have champagne taste and they're on a beer budget. It's like, no, slow down a little bit, because not only when we're looking at debt to income ratio, we're looking at what's reporting on your credit report and the new
Yeah.
mortgage. We're not looking at what you're paying for food, what you're paying for gas, what you're paying in doctor bills. And you got to take all that in consideration. Are you going to have a new child? How much is that going to cost you? Da 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 da. And so I try to, I'm not a financial advisor or anything, but I want people to look at the whole picture, because the last thing you want is to help somebody get into a home and then you find out a year or 2 years from now that they end up foreclosing on it. You know what I mean?
Yeah. Yeah.
So, so you got to be careful not to put someone in a bad situation.
Right. That's something we never want to do. And even if
Exactly.
we're looking at houses, we don't want to have them look at a house they really can't afford and fall in love with it.
Right.
That's just a bad situation. But anyway, well, listen, Jim, I really appreciate your time. This is such a big topic, and there are so many other things I know we can talk about. But how can somebody get in touch with you if they have questions, further questions they want to ask you directly?
Well, they can give me a call on my cell phone,
Mhm.
910-742-5096. I'm available 7 days a week, up until 9 o'clock at night. I'm getting older, so I go to bed by 10. So, um, but I am up at 5:30 in the morning. Um, so I'm always available. If I don't answer, leave me a voicemail. I'll call you right back. Um, you can email me at jbinion@nexamortgage.com. So it's jbinion at nexamortgage.com. But I'm kind of old fashioned. I prefer a phone call so we can get to know each other a little bit.
Yeah, I think that's a really good way because then you can
Yeah.
yeah, get to know each other better and hear the inflections and um,
Yeah.
that's just a good way to do it.
Or you
Uh,
can text me. And if you
yeah,
text me, I'll still give you a call back.
sounds great. Sounds
All
great.
right.
All right. Well, listen, Jim, thank you again for your time and
Hey, no problem.
appreciate all these answers to these questions and further development of other things too. And
Okay.
hopefully we'll be able to help some people with their finances and understanding the mortgage lending process even better.
Yeah, definitely. Thank
All
you.
right. Well, thank you for taking your time to listen and pay attention as we talk through this discussion. Again, my name is Rick Hendricks. I'm with Keller Williams Realty and the Hendricks team. Look forward to further opportunities to speak with you.